Dividend kings are stocks who have a rich history of increasing dividend payments for at least 50 consecutive years, and a few weeks ago, I made a video reviewing every single Dividend King stock and came to the realization that many Dividend King stocks are actually not companies I would personally invest in. Now, with that being said, I also believe there are Dividend King stocks that could be solid additions to investors' portfolios. So in this video, we're going to review what I believe are the top 5 Dividend King stocks. To analyze these stocks, we're going to be using my spreadsheets from tickerdata.com and the Ticker Data add-on that allows you to automatically import stock financials straight into your spreadsheet. You can get access to Ticker Data at the link in the description. So let's go ahead and dig in. If we look at the spreadsheet that I have listed out here, we can see a list of all 53 Dividend Kings as of the beginning of 2024. And like I mentioned earlier, many of these stocks are actually not companies I would consider adding to my personal portfolio, and in fact, 2 of these companies have actually cut their dividend payout over the past few months, and one of those is Leggett & Platt and 3M Company. So just because a company is a Dividend King doesn't make them a great dividend stock. Now, the first Dividend King stock that I think is actually a pretty decent company that we're going to look at today is going to be AbbVie, and that's stock ticker ABBV, currently trading at $163.33 per share. And if we look at them over the past year, up around 12.72%, and over the past 5 years, up over 100%. And keep in mind, that doesn't even include the gains that you would have seen from dividend payments. They have a pretty nice starting dividend yield. In fact, let's go ahead and jump over to my dividend breakdown spreadsheet, again available on tickerdata.com. We'll plug in ABBV and hit enter, and you can see all this data is going to automatically load in. Now, this company has a very nice starting dividend yield. It's sitting at about 3.8%. That's a pretty decent yield. But one of the things we can also see is the company has had a phenomenal dividend growth rate over the past 10 years and past 5 years. 10-year dividend CAGR is sitting at 14%, and the 5-year at 7.7%. And what I really love about this is completely backed by free cash flow growth. The 10-year free cash flow CAGR sitting at 14.34%, and the 5-year at 11.52%. So we can see the dividend payments have rapidly grown, going from around $1.60 in 2013 all the way up to $5.92 in 2023, and 2024 the total dividends is projected to be at $6.20. So again, very rapid dividend growth. What I also like to see is a nice low free cash flow payout ratio. It's a pretty healthy range for a company that is a Dividend King, sitting at 47.77%. And if we look at the free cash flow payout ratio over time, we can see it's been pretty consistently slightly below 50% over the past 6 or 7 years. And then finally, if we look at that free cash flow versus dividends paid chart, we can see the free cash flow is easily covering those dividend payments every single year. Now, in 2014, you can see it did get pretty close. Free cash flow was around $2.9 billion, while dividends paid out was around $2.6 billion. But since then, free cash flow has grown at such a rapid rate, it's now easily covering those dividend payments. And for example, in 2023, free cash flow was sitting at about $22 billion, while dividends paid out was sitting at about $10.5 billion. Now, if we look at the stock screener spreadsheet, one of the things you will notice is the payout ratio was sitting at over 200%, and this is payout ratio as a result of earnings, and really this was because of a huge drop in earnings per share in 2023. We can see 2021, $6.48, 22, $6.65, but there was a big drop in 2023. But again, free cash flow overall trending in the right direction, so I don't necessarily think the dividend is at risk. But one thing we do have to keep in mind is this company is a pharmaceutical company. It's very important to keep in mind, what does this company have in their pipeline, and how long will the patents last for the resources that they currently own? Again, if the pipeline is weak for this pharmaceutical company, then we'll probably see pretty slow revenue per share growth, which long term would likely hurt the dividend growth of this company. Now, last thing I want to point out about them is if we look at the starting free cash flow yield for them, it's sitting at 7.64%. That's a pretty good valuation for this company. So now we have one of our 5 Dividend Kings, and that first one was AbbVie. Now, the second one that I want to look at is one that I hold in my personal portfolio, and that is Lowe's, stock ticker LOW, trading at $222.11 per share. And over the past year, they've done pretty well, up around 9.37%. And if we look at the past 5 years, up over 103%, and over the past 10 years, way outperforming the market, up around 372%. So let's go ahead and jump into the dividend metrics for this company. We'll go ahead and come up here and plug in LOW and hit enter, and this data will automatically load in. Now we can see the starting yield for this company is a little bit lower. It's sitting at about 2%, so it's pretty close to the average starting yield of companies in the S&P 500. But here's what's really impressive. That 10-year dividend CAGR is sitting at 18.29%. So the dividend payments for this company have absolutely exploded over the past decade. Look at this growth, going from around 68 cents per share in 2013 to $4.30 in 2023. That is massive dividend growth. And we can see the payout ratios during this time have stayed pretty low as well. The current payout ratio as a result of earnings sitting at about 37%, and free cash flow payout ratio sitting at about 41%. And again, the 10-year dividend CAGR is high, but it really hasn't slowed down any over the past 5 years either, sitting at about 16.39%. Now, one of the things you'll notice in 2020, there was a huge spike up in free cash flow for this company. This is when a lot of people were focused on home renovation or do-it-yourself projects. And this was also during a time of low interest rates. Now, over the past few years, we can see free cash flow has slightly declined from that 2020 high, but it's still quite a bit higher than it was back in 2015, 2014, or even 2013. But something we do have to keep in mind, when free cash flow is declining and those dividend payments keep rising, as we can see here, that free cash flow payout ratio is going to increase over time. We can see in 2020, it was as low as around 18.41%, but since then it's jumped up to around 41%. Now, that's still a healthy range in my opinion, especially for a company that's been increasing dividends for over 50 consecutive years, but it's something to keep an eye on. Now, if we jump over to our stock screener spreadsheet, we'll come up here, plug in LOW and hit enter. We can see there is a lot of things going on here that I really like. First off, revenue per share has grown by a decent amount over the past decade. It was below $50 per share at around $44 per share. We can see it spiked all the way up to $154 per share. So revenue per share has jumped up quite a bit. The same has happened to earnings per share, and the same is true for free cash flow per share. And one of the things that really boosted these metrics is they have bought back a ton of shares over the past decade. Look at this, going from around 1.15 billion now all the way down to around 629 million. So they have drastically reduced the amount of shares outstanding for this company, which is a great way to reward shareholders, assuming that the company is not overvalued. Now, we can also see the company has had high levels of return on invested capital. So a lot of these things that I like, but there is one big potential concern for the company, and that is the debt to assets ratio. We can see this has climbed up quite a bit over the past decade. Starting out in 2013, it was in a very healthy range at about 32.14%, but in 2023, it jumped all the way up to 92.59%. Now, debt to assets ratio is essentially the total debt over the company's total assets. So basically what that means is total assets, yes, it probably has been climbing during this time period, but debt has been climbing at an even higher rate. This is starting to get in an unhealthy range in my opinion. And with interest rates now quite a bit higher and a potential slowdown in the housing market, this could be a problem for the company. Now we can dig into this problem just a little bit more if we jump over to my balance sheet breakdown spreadsheet. We'll come up here, plug in LOW. The data will automatically load in. Now, like we've already touched on, the debt to assets ratio over time has grown pretty significantly. But one of the things we'll notice is the current ratio, I'd like to see it a little bit higher, but as of right now, sitting at 1.23, it's in a somewhat decent position. All of the total current assets do cover the total current liabilities. Now, what does that mean? Well, it means that the debt problem for this company is long-term debt. So again, one potential concern is making the interest payments on those long-term debts. So if we come down here, let's look at the company's interest coverage, essentially telling us how easily they can make those interest payments. We'll use the ticker data add-on, come up here, select Lowe's, select interest coverage, and select 2020 and hit enter. We can see in 2020, their interest coverage ratio was sitting at about 9.13. But if we drag this formula over through 2023, we can see in 2021 and 2022, it actually climbed a little bit higher, which is a good sign. But in 2023, it dropped down to around 8.75. Now, I definitely don't think this is necessarily in an unhealthy range, but this is definitely something I'm going to be keeping my eye on. So now we've looked at 2 of our 5 Dividend King stocks, and the third one we're going to look at is actually one of the highest yielding positions in my personal portfolio, and that is Altria Group, stock ticker MO. The company is currently trading at about $46.15, which is actually pretty close to its 52-week high. We can see over the past year, up around 2.72%. Let's go ahead and jump over to the dividend breakdown sheet. Come up here, plug in MO and hit enter, and the data will automatically load in. Now, this company has a very high starting dividend yield. Look at this, sitting at about 8.5%. So the majority of the returns you'll see from this company are going to come in the form of dividends. They've been increasing dividends at a decent rate for a high yielder and for a company that is a dividend king. We can see that 10-year dividend CAGR at around 7% and the 5-year a little bit lower at about 3.63%. Honestly, again, I think that's a pretty decent dividend growth rate for a company yielding around 8.5%. But here's where people have a major concern with this company. Look at the payout ratio, sitting at 83.38%, and the free cash flow payout ratio, sitting at 74.57%. But let me tell you why you shouldn't be quite as concerned as you think when looking at these payout ratios. This is actually in line with management's plan for the company. In recent earnings report, the company has stated that they have a target dividend payout ratio of approximately 80% of the adjusted diluted earnings per share. So if we jump back over to our dividend breakdown sheet, we now know that the payout ratio is actually a result of management's plan. They feel that paying out big dividends is the best way to currently reward their shareholders. And if we look at the free cash flow payout ratio over time, we can actually see this has stayed pretty steadily right at at around 80% since around 2019, which is something we really like to see from a big dividend payer. And if we look at the free cash flow versus dividends paid out, just about every single year that free cash flow is covering those dividend payments. Since 2018, every single year since then, that free cash flow has been covering those dividend payments. If we look at our profitability sheet, we'll come up here, plug in MO and hit enter. One of the things that I do think is worth pointing out about this company, yes, the 5-year revenue CAGR and the 10-year revenue CAGR, they are relatively low. The company's not necessarily seeing very fast revenue growth, which is typically a pretty big concern. But they're doing something that somewhat makes up for this. Look at the gross payout ratio over time for this company. In 2014, it's sitting at about 56%. But in 2023, it was now sitting at almost 70%. So they're seeing increases in the gross profit ratio nearly year after year, which in turn is bumping up their net income. We can see the 5-year net income quite a bit higher than the 5-year revenue CAGR, sitting at 3.15%, and the 10-year sitting at about 6%. So despite the low revenue growth, they are still seeing increases in their bottom line due to better profit margins. Now, if we look at the stock screener, one of the things you'll notice, even though revenue really hasn't increased that much, revenue per share has done a little bit better, going from around $8.84 in 2013 to around $11.54 in 2023, and really this is due to the company buying back some shares during that time period. Now, the fourth Dividend King stock we're going to be looking at is pretty much the complete opposite from Altria from a dividend yield perspective, and this is one that I haven't talked about on the channel much before, but that is SPGI, and that is S&P Global, currently trading at $440.28 per share. Now, historically speaking, this company has seen market-beating returns. We can see over the past year up around 18.24%, past 5 years, 103%, and over the past 10 years, 435%. But if we look at them year to date, they're actually pretty much flat, down around 0.05%. Now, we can see there's been a little bit of a recovery since April, which is when the stock dropped by quite a bit after releasing their latest quarter's earnings report. But let's go ahead and jump into the dividend metrics. Let's come here and plug in SPGI. And like I said, from a dividend yield perspective, pretty much the complete opposite of Altria. Dividend yield is below 1%, sitting at 0.83%. So why would we even consider adding a stock to our portfolio with a dividend yield below 1%? Well, here's what we have to understand. Look at the free cash flow growth from this company over the past decade. It's sitting at about 17.7%. When a company is growing its free cash flow at that high of a rate, their ability to increase their dividend payments during that time period also explodes. So the 10-year dividend CAGR is sitting at about 11.74%. So that is no doubt very fast dividend growth. But if they wanted to, they could really increase it by even more, and that dividend still be in a very healthy range. And moving forward, we know that they still have the ability to do that. So looking at these yearly dividend payments, we can see a lot of growth over the past decade, and payout ratio sitting at 43.68, and free cash flow payout ratio sitting at about 32.16%. Now, if we look at the free cash flow payout ratio over time, it looks pretty wild, and that's basically because if we look at the free cash flow versus dividends paid, one of the things we'll notice in 2015, the company had very little free cash flow, while their dividend payments was quite a bit higher, and that's why we see the huge spike in free cash flow payout ratio. But other than that, the free cash flow payout ratio over the past decade has stayed in a pretty healthy range, as we can see, and in fact, it even would be as low as around 20% for a pretty long period of time. Now, one of the things you need to understand about SPGI is this is a credit rating services, and something I love about these businesses is they have very nice gross profit ratios. Look at this. Since it looks like around 2019, their gross profit ratio has been anywhere from as high as around 73% to around 66% in the most recent year. One of the other things worth pointing out is if we look at the debt to assets ratio for this company, it's declined by a pretty considerable amount over the past 8 or 9 years. So a lot of that free cash flow they've generated has likely been used to pay down debt. So far we have looked at 4 out of our 5 companies, and a couple of them have been on the higher yielding side. We had Altria and AbbVie, decently high starting dividend yields for both of those companies, and we had a couple on the lower yield side with Lowe's and S&P Global. Now, the last company we're going to look at is actually one that's kind of in the middle, and this is a company that has had some good earnings reports over the past 5 years and a couple of really bad ones, and they've also been in the midst of some political controversy. And this company is Target Corporation, stock ticker TGT, trading at about $155.43 per share. Over the past year, they're down around 3.44%. But if you look at the past 5 years, there's a couple of things I want to point out. First off, look at 2022 right here. After a earnings report, they had the single largest drop in their share price in the company's history, going from around $217 per share to around $155. This was a massive drop in share price. In 2023, wasn't much better. In fact, we can see in 2023, the company traded as low as around $109 per share. Now, as the company was dropping, I actually added a few shares to my portfolio at around $120 per share, so I'm in the green by a decent amount with this company. But let's go ahead and start looking at the dividend metrics. We'll plug in TGT and hit enter, and again, the data will automatically load in thanks to the ticker data add-on. Now, the starting yield for this company, again, kind of in the middle, sitting at about 2.83%. And we can see the dividend growth over the past few years has actually been really good for this company. The 5-year dividend CAGR sitting at about 11.10%. So we can see a big hike here, going from around $3.16 to $3.96, and then $3.96 to $4.36. So pretty decent dividend growth there. If we look at the free cash flow growth, not quite as good. The 10-year sitting at about 2.21%, but they did have a couple of years where it was pretty high, but overall from 2013 to 2023, the growth hasn't been anything too crazy, but the 5-year dividend CAGR quite a bit better at about 9.2%. Now, the free cash flow payout ratio for this company is sitting at about 52.71%, so they're using about half of their free cash flow currently to pay out dividends. Now, if we look at the free cash flow payout ratio chart over time, we can see 50% is pretty close to where they've been over the past decade, but if we look at 2022, we can see there's actually negative free cash flow payout ratio. Now, what does that mean? Well, if we come down here, we can see in 2022, the company actually reported negative free cash flow, and that's going to lead to the negative free cash flow payout ratio over time. Now, something else that is worth pointing out about this company, if we jump over to our balance sheet breakdown, one of the things I want to point out is if we look at the debt to assets ratio over time, overall, I think they're in a pretty healthy range. It looks like they're staying in the 30s to 40s, which is a pretty healthy debt to assets ratio. But if you look at the current ratio, it's not quite as good. We can see it's quite a bit lower, which I do think is somewhat common for retailers. And as of 2023, the current ratio was sitting at 0.91. Now, a lot of the times, retailers have lower current ratios due to the quick inventory turnover that they see. So it's not necessarily a red flag in my opinion, but something to keep an eye on. And in fact, the reason the company saw its largest single day drop back in 2022 was actually because sales were slowing down and inventory was growing by quite a bit. So it's important to keep an eye on those inventory turnover ratios. So in my opinion, those are 5 different Dividend King stocks that are actually worth considering adding to your portfolio and looking into just a little bit more. Now, there are some other companies worth mentioning here. Obviously, we also have PepsiCo, Johnson & Johnson, and we also have the Coca-Cola Company. All 3 of those companies have pretty nice starting dividend yields sitting around 3 to 3.3%. And while you likely won't see high growth levels from those companies, you will get very steady and predictable dividend payments and dividend growth. Now, that being said, there probably are other companies that I would consider adding to my portfolio, but the ones I mentioned today are the ones that I watch most closely on my stock watch list. Go ahead and let me know in the comments down below what other Dividend King stocks you own or are interested in. And like always, if you'd like to get access to any of my spreadsheets and also the ticker data add-on that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.